All right, today wasn't the day that we really wanted to see. After a big down day yesterday, it would have been nice to get a little bit of a rebound, but it might actually have been the best day possible that we could get. We got multiple signals today that typically suggest that we might be done with the selling. Whether today ends up being the low point or tomorrow or the next day, doesn't really matter. But what matters is we might be pretty darn close to the low, if not already there with today's move. Knowing that as soon as we bounce, we're going to bounce up pretty quickly. We've talked about that in the last couple of videos. We're probably pretty close to that bounce. It might actually start on an intraday basis. So again, it could be tomorrow, it could be Thursday or Friday. But regardless, if we do get any more moves to the downside to a lower low, it probably won't be very much. And again, I'll explain all that why and what I'm seeing today that would suggest that. We'll take a look at what's driving this price action, as we always do, taking a look at our breadth indicators, which finally showed a little bit of an exhaustion. So we'll break that down in today's video. And then we'll also take a look at our sector rotation, as significant as it is now kind of reaching extremes. So we'll break that down, and then we'll take a look at our trade idea of the day. So let's go ahead and get started. Today is Tuesday, March the 11th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed. You can also get there by coming up here to the Market Outlook in the menu and click on Live Trade Review. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, the more you can it helps us get our content out to all of our followers on these platforms. So thank you for those who do that day in and day out. Those who don't, you can do it right now while you're watching. And we can try to get back up to 50, which was what we hit on Friday's video. We'll try to hit it again. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, and we got our cluster. So it was off and on all throughout the day as we were going down and then up. We were down more than 10%, barely more than 10%. At the lows of the day off of this close at 61.47, we ended up only down about 9%, but it was low enough to get the near-term line to below 20, which means an oversold cluster. As you can see, we tend to get these oversold clusters, or at least close to an oversold cluster, at the lows of these moves. And the intermediate line gets in, the short-term sentiment's really bearish. You tend to get that. In this case, all the lines are, above the 14th percentile or higher, which you can see from my cursor over to the left. Follow my cursor all along the left. You can see those clusters, they were all below the 14th percentile. So much lower here. If I were to zoom out a little bit so you can see other clusters, like for example, this one here, 14th percentile, you can see where the green line is, all below it there too. So a little bit more bearish at the end of 2023. And you can see even we've been comparing ourselves to this week, this early part of January 2022, and that had a cluster. The intermediate line was not very low, but the short-term sentiment was really low. And even some of these intermediary lows in between during the correction also had, this one had a ton of clusters. 1, 2, 3, 4, 5 in a row, 6 out of 8. Another one there. I mean, they were all over the place. So clusters tend to mark kind of a low point. In this case, since it's also kind of coinciding with the zigzag at 9%, then we're probably pretty close to the low point right now. Again, whether it is the low point, I don't think so, right? Because I think we've now, again, 2021, we got to 9.8. Now, keep in mind, the cluster came right there, so we still had, 1, 2, 3, 4 more days, so it actually formed a low, and it was a little bit lower. If you look at, where we were on the day we got the cluster, 43.97, 94, off of this high point at 47.96, 56. So we were only down 8.3% when we got that cluster, and we went a little bit lower down to 9.8. Here we were at 9.3. So we are pretty darn close to that 10% mark on a close-to-close basis, close enough to where I think, and two, where the close enough. I think that on a bounce, if and when we get a bounce, because we will get a bounce. Remember, a green tag always comes after a red tag, so there will be a green tag, which is a 5% move off the close, right? So a 5% rally to the upside off the close. So we will get a green tag, and it will happen fast. It will happen so fast within a matter of just a few days. And like I said, if we don't have the green tag by next Friday, we should be on our way. But I think we'll actually have it by next Friday. We'll have our green tag going into options expiration. So we'll get a 5% rally. So whether today is the low point or whether we go down maybe another day or two, a little bit lower, maybe below 10, maybe a little bit below 10, whatever. It doesn't matter. What does matter is we got close enough to 10 and we got the cluster that we are, if today's not the low, we're really close, right? We're really close to that low. And like I said, we might go down marginally more, maybe get a second cluster, like a back-to-back cluster, but probably nothing more than that. And we'll rally back up to the upside. If I take a look at the NASDAQ 100, it also got a cluster today, finished low enough to get one. We're 8% below the moving average. Market sentiment is crossed below the midpoint. Again, all lines are down there. The Dow Jones Industrial Average actually had the worst day out of all the indexes. It was down more than 1%. It also got a cluster. It's 5% below. Remember, it's been kind of catching down to the downside because it held up better at the start than the other indexes. But now it has caught down, so it has a cluster as well on the Dow Jones Industrial Average. And then finally, your Russell 2000 did not get a cluster, but it was very, very close. You can see both short-term sentiment lines finishing just above 20. So at the lows, we did have a cluster. We ended up not getting one. But you can see we've been close multiple times to getting a cluster on the Russell 2000. So we're pretty darn close. And remember, the Russell 2000 is in a correction, right? So it's not, we're not like looking for it to hit me. It hit the 200-day moving average right here and then broke the 200 days, now working as, in fact, it's actually close to the 200-week moving average, which is when the correction ends, right? That's what a correction is. That's the point of a correction, is to drop below the 200-day and work its way to the 200-week, and it's there. So we're already, there wasn't very much of a gap to fill in. The correction gap was very small, which again makes the Russell 2000 very susceptible. Much bigger gap in 2021, 2022 makes it more susceptible to a bear market, like again that we were really on the cusp of getting in 2023 when we did break below for multiple weeks the 200-week moving average, broke below all these weeks, but this close right here on that last week of October, and then we rebounded in a big way, a little bit of a fake out pattern, and then 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks later, going into the end of the year, we were above the prior highs. So a little bit of a fake out pattern in the opposite direction, kind of like this fake out pattern that we got to the upside that ended up faking out, and now we're moving down, down to the downside. So that's kind of what we're seeing there. If I were to take a look at the weekly chart, that's how it's setting up right now. Again, we're only 2 days in, and if we start to get that explosive rally by the end of the week, this is not going to end up this way. But as of right now, it is a lower close, a lower low. The close is below last week's low, and again, one of the biggest bearish candles that we've had since the last correction, right? You have to go all the way back to the beginning stages of the last correction for us to have a pullback with this big of a candle. 5.33 the week of January 24th, and right now we're at 5.4. Again, it won't stay this way if we start to rally by the end of the week. So it's not done. But again, it goes to show, again, on that same week, January 24th, we closed below the 40-week exponential moving average, and we're doing that again here on this significantly large candle. So bigger candle than what we've seen, and we had broken the 5% mark on this gap. We broke the 5% mark on this gap again. So we're following a very, very similar pattern to the beginning of 2022. After all of last year, I was telling you how similar 2024 was to 2021, especially towards the end. Now the beginning of 2025 is playing out very similarly to the even more beginning of 2022, the very first few weeks of 2022 there. Obviously, we have 3 red arrows across the board, all across the board there, 3 red arrows. If I take a look at the 2-line version of this chart, you can see we are below the 200-day moving average for the second day in a row. The MACD is way below 1%. In fact, it's below 1.5%. Again, that's one of your deepest levels of MACD momentum, especially on a pullback, since we dropped to 2% there, 2.1. So we are at 1.76. The stochastics is pretty low down there. If you take a look at some of the other oscillators, like the DMI, it's clearly bearish, above 30 on the negative, well below 20, below 10 on the positive, extremely low. This is another reason why there's a good chance that we bounce here pretty quickly and pretty explosively, because that is an extreme. Being at 7.5 on the positive, anything below 10 is extreme, like extreme. So the fact that we are still below 10 and way below 10, again, just kind of makes it look like that was an extreme move to the upside, and you saw how quickly we fell after that parabolic peak. We're moving on a parabolic peak right now. The negative indicator is not as high as the positive indicator got, but the ADX is explosive, right? It came from being below 10. This one came from around 15, just over 15. So we might not go as high, but remember, we also came from a much lower level, and it's probably just as parabolic on the DMI as what we saw over here in the opposite direction. And we saw the rebound, and we saw the fall, the rebound to the downside. I expect we'll get something similar to the upside here. If I take a look at the RSI and the CCI, of course, still below 150 on the CCI, still below 30 on the RSI. Again, we haven't seen that in a while. So we are clearly bearish here. We have to get back above 50 and then above 60 to change that, and that's just obviously not the case right now. So we'll go to today. There we go. And of course, the weekly, we can't keep that green going because the weekly CCI broke minus 100 last week. It got to minus 164, and it's way below minus 200 this week. Again, that's even lower now than that week of January the 24th when it got to minus 233, and right now we're at minus 254. But keep in mind, the week's not over with. So we could end up with a very similar result. Remember, as bad as that was the week of January 24th, here, it was actually a bullish week. So if we follow suit, that means we probably finish with a bullish week this week, or at least maybe a bearish week, but higher than the open of the week because of the gap, filling in that gap there. Let's take a look at the Ichimoku cloud. Remember, we have an intermediate strength, a mature strength trend going on to the downside, well below the cloud. Again, if we get below the cloud and we'll come right back above it, that means, again, most likely correction stage is coming. So we'll kind of keep our eyes on that as we get closer to the pink shading. If we're in pullback, we need to be above the pink shading by the time we get there. The pink shading comes from the pullback, and then obviously the rebound back up off of the low point most likely puts you above the pink shading, by the time we get to that 26 days later. If we're this far below it, it's now making it less, especially with a mature trend, it's making it less likely we'll be there. So you can see over here how we dropped, we formed the pink shading, but then we rallied quickly, and by the time we got there, we were easily above it. So that's kind of the idea there, and we only had an intermediate strength trend. It was very brief. That's not the case this go around. And if you take a look at the Bollinger Bands and the Keltner channel, still in the lowest quartile of the bandwidth. The bandwidth has now exceeded, after the fake out, right, of getting down to 150-day lows, we have now broken the 150-day highs, right, which, again, the last time we did that on a downward move was early 2022. And we are clearly pushing the lower band lower. We're way below the Keltner channel, way below, which is another sign that we're probably going to get that bounce quickly. You can see the momentum drop below 2,000 at 2,400, minus 2,400. Again, that's an extremely low point. In fact, we didn't even get that low over here. We were only at 2,200. So this is the lowest the momentum has been since the washout stage over here, and it's even lower now than it was then. So we're extreme, right? We are very, very extreme here on this momentum. I mean, you have to pretty much go back to COVID to have a lower level than this. That's lower than any level of 2022. So this is we're pretty extreme right now in the momentum to the downside, as you saw with the MACD, as you saw with this. Most likely that means that we're going to rebound quickly. Again, whether it's tomorrow, most likely by the end of the week we'll start it. I don't know if it necessarily will be tomorrow, but we are. That I mean, it's that close that it could very well be, if not tomorrow, Thursday or Friday, and we're going right. Because remember, when it starts, when the rebound starts, we'll get that 5% very quickly, within a few days, and like I said, most likely before next Friday's options expiration. We did get a new low here, so we have the 100 still there. We have to get that below 70 before we're really feeling good. And remember, that will happen. It will happen. We might not get a new 4-week high point, but whenever we had this pullback, it did drop below 70 there on the bounce back up, the failed bounce. And then it just went back to new lows eventually and got the red tag again. So it didn't get the green. The green hit 0, this dropped below 70. So we were set up, but we just failed, right? We just failed there. And that's kind of what we're probably going to see here. We're to the 10% mark on the 4-week range, which again is just crazy because it's been a long time since we've been that bearish. It's been a long time since we've been that bearish here. You can see the last time we were above 10% was on a bullish move there, and again we did get over 10%. It got all the way up to 12% on that original pullback in early January of 2022. That's why I say we still might be a day or two away from the actual low point. If I take a look, let's see here at the today's range and volume. Of course, they're going to be very large because you can see all the 3 red arrows. You can see a very large range, 12 points. Volume still 87 million, so the averages are still moving strongly higher. In fact, we're almost to that 2% mark. We got up to 1.83. We were already rebounding by the time it happened. We're not rebounding it. Remember, the first few days of the rebound will also be very large too. The ranges will. So the peak of the ATR, of the normalized ATR, actually happens after the low, because you get the big moves to the downside and you get big moves back up to the upside. That's why we get the 5% so quickly. You can see the volume is now moving up. It's actually higher than it was. If you take a look at the money flow here, you can see the money flow is starting to move lower a little bit at a quicker pace. Again, the last time we were here at this level was back on September the 11th of last year. We were at 554.42, so it's pretty close to where we're at right now. And on that day, the money flow is right there. So we still have we're still not as bad to the downside there, but obviously we can play catch down, right? We've seen we can play catch down. If you take a look at the volatility index, you can see we're up here in the high 20s. We still haven't broken 30. We haven't really broken out. We were down today on the volatility. Even though the market was down, volatility was down. We're still above the 105% mark, well above the 100% mark. We haven't achieved that 115%, which is, if you don't achieve at the beginning of a correction, you tend to do it at the end. So it'd be kind of more ideal if we got it here early. The VVIX is still very, very high, so we're still prone to a big move in volatility, right? Like I told you yesterday, we haven't had a big move in volatility. We haven't had a single day during this decline where we've been above 20%. 19.2 was the closest we got yesterday, after that gap up of about 5 2/3%. So we still haven't had a big jump in volatility yet. They really kind of solidify, because when you get the big jumps, that's when we start to falter right after, and it kind of builds into it. You can see it builds into it. So we've been kind of up and down, up and down, up and down, and we might still be one of those days away from actually setting the low point, and that would definitely be a washout low point if that were to happen. If we had right now a 20% move to the upside on the VIX, then you're looking at 5 points. You're definitely going to be 5.5 points. We're definitely going to be above 30 at that point. And we are, we've been gradually moving higher in volatility. It's been a nice steady move, which is rare for volatility. It's rare for it to be steady. I told you earlier yesterday that we have gone up in 13 days the same amount that we went up in one day back in December, and really just a couple of days in August. I mean, that's how volatility behaves typically. We get the big spikes. Obviously, you can see it hasn't been a big spike, but it's been steady enough that we are pretty well above the 200-day moving average. It can get higher, right? That's, it's, obviously this is not an extreme. If you look at how far above this 200-day average value, it is pretty high, but that's, again, if I go back to analog that we've been using, you can see back over here on that first pullback, which would have been in January right there, we were 69% above the moving average, and right now we're 59. So we are not extreme in the least bit. It's been kind of steady and gradual, and we'll see, if that will continue to be the case for how steady the move has been. Let's take a quick look at the skew, because I usually like to look at the skew as well when I'm looking at volatility. Remember, we want skew to drop hard, right? That's kind of the ideal, because then we really know that we're close to the end. And then you can see we actually did not drop hard. Yesterday we jumped to 146. Today we did drop back down to 132, so right here where my cursor is. So we are pretty decently down. You can see the drop has been pretty steady. Way bigger drop than what we saw in early 2022 when it was only about 3% drop. So it's a much bigger drop. Of course, we came down from a much higher level, which makes it more likely that we will drop this much, and it will drop even more tomorrow. So again, another sign that we're getting a little bit closer. On that first stage of getting to around 130, maybe a little bit below 130, kind of being so extreme that we can finally set the low point here and a rebound. All right, now let's talk about break down what's driving this price action. Again, you can see the 3-month returns, but let's just take a look at today first, and then we'll take a look at this rally that we've been having. But you take a look more, like you can see, like gold started off today strong, finished near its highs, and it really didn't move at all after the opening gap. Commodities gapped up, fell down throughout the day along with equities, finished positive. Yields started off the day down just a little bit, but then rallied and finished at their highs. The dollar was down, so you had yields and commodities up, but the dollar down. That's again usually a combination for. It's usually not a combination for risk aversion, but that was the case today. Commodities and gold, the yields all up, the dollar down. That's pushing gold up. The dollar's really been weak. The dollar's had a significant move. There's yields. Closing again back above the 8-day moving average with that MACD above its moving average. But look at the dollar move. It's just a significant move. Big time momentum move down to the downside. We're really moving lower, which when you look at the biggest component of that index, which is the Euro US dollar, breaking above its 200-day moving average, significant momentum to the upside. As we mentioned last week, big time weekly move, one of the bigger weeks that we've had in a while. And now closing over the 200-week moving average. And that, of course, is significant. Now, again, the week's not over with, so we might not end up closing above the week. And the MACD has just turned positive, stochastics in bullish territory. But again, like we flirted a couple of times here in 2023, and then we had this drop on the dollar that really put pressure on equities. And then again, we had this drop here, and the markets actually kind of rallied on that. In fact, when you look at the correlation right now with the dollar with equities, again, it's generally been a negative correlation. A falling dollar is generally positive, but right now it's a very strongly positive correlation. They're both moving together in the same direction, and the dollar is heading into a seasonal period of time of weakness. It generally peaks right about now and then falls down towards the beginning of May. Whether we played that out this go around because of how much we're already down remains to be seen. But that's a pretty significant move, and of course, the other big move is on commodities, right? Commodities. Let's take a look at the commodity ETF first, and we'll take a look at crude oil. But commodities still unable to get above resistance, significant resistance here. And then looking at crude oil, you can see is 52-week lows and below 60. I mean, generally in the past, this has been very, very positive for equities to have. I mean, this is a pretty decent reflection of falling inflation expectations. And again, that still is not. I mean, we'll find out the CPI here this week, but that's still not having an impact where we want it to have on risk appetite, right? And sending risk appetite higher, which falling inflation has been what sent risk appetite higher, like I said here in the last couple of years. So if I take a look at the breadth kind of fell down more today than what we've seen, which again might be a sign that we're getting a little bit of some exhaustion here. We got down to the lowest level, minus 57, obviously back below zero on the summation index. But the big drop that I saw here this week was actually on the number of stocks above their 50 days. So yesterday, The number of stocks above the 50-day still stayed relatively high. By the end of the day today, clearly dropping below 200. So this is the first drop we've had during this decline, getting below 200, and that's a clear drop. I mean, again, one of our bigger drops that we've seen here on a, let's just go to a one-day basis here. But on a rate of change, one of our bigger drops that we've seen, let's try this again. Rate of change is actually down here. There we go. You can see the big drop here. Again, one of our bigger drops that we've had, more than 20%. So that's a significant move. Remember, this number of stocks above their 200-day also dropped. I mean, it dropped below 250. It's well below 250 now. So as a result, you still have this ratio not spiking, right? This needs to spike before we can really say that a low is, even on the intermediate term basis, has been set. We're ready to rebound here. So we're definitely not at exhaustion levels. Though, like I said, the new highs and new lows, or the number of stocks above those moving averages dropped. The number of new lows increased again today, which is going to make the net new highs and lows, still stay down at significantly bearish levels. In fact, the the moving average has now dropped below 100, as you can see there. If I were to zoom out a little bit, so you can see the beginning of 2022's correction. That's what happened, right? We had been so bearish on the net new lows in December of 2021, that by the time we got to 2022, we were well below 100 on that moving average. It was hard to be bullish, and that's again, that's kind of the stage we're at now. Dropping below minus 100, and we would need a significant rebound to kind of alter that back up to the upside. So like the one we just had. Where the average fell as well below minus 100, but we were able to rebound up to new highs, slight new highs, small new highs, but we were able to rebound up there. Doesn't look like this has been a lot more bearish here than what we saw there, so it doesn't look like we're going to be able to immediately rebound back up there, which again is another indication, another sign that we are more likely heading into correction with this pullback, and not just bouncing up to new highs like right now. Again, just a reminder that a correction generally means that we'll get a green tag, but that green tag will essentially get us up to these moving averages here, the 30 and the 50. So back above the 200, up to the 30 and the 50, and then fail at those levels. Maybe get up above it a little bit, but for the most part, fail at those levels, and then we falter back below the 200 to new lows. And we go, and the corrections last months. So it takes months to get back up to new highs, which is why we don't want to have a correction. We want just a normal pullback. And this technically still could be a pullback, but we'd have to break back up above these lines quickly, right? Quickly here. And again, the deeper we go, the less likely that is to happen. Let's take a look at how the sectors move. So that's the kind of the key as to, again, another reason why, because your biggest sector doesn't look like it's going to break above those moving averages anytime soon. In fact, the point of control, instead of being down to here below us, there is a pretty decent volume node that would suggest, as well as the value area, that would suggest we might be done dropping here on XOK, but now the point of control is actually above us. So all the resistance is above us here, not below us anymore. And that's a big change, again, suggesting that we've had a change on sentiment here. We are below the 50-week moving average clearly, and most likely it means we'll bounce back up against something like this, back up here, and we'll see if we ultimately fail or not. But I mean, the MACD is clearly bearish. The stochastics on these are weekly charts, is at bearish levels. So we are most likely, and not just that, but from a relative rotation, from a relative strength chart, again, you can see the weekly rotation is clearly going in the wrong direction. But on the daily chart, which is what we like to look at here, again, we're pretty, both these lines are pretty clearly at bearish levels. Here they are visualized on the chart, so we can take a look at a daily chart and see the one-year daily chart. Again, you can see how low the relative strength has been. The last two low points has been lower than what we had seen previously. Outside of this August move, it's lower than what we've seen, and we're below these moving averages. The ratio of the S&P to its equal weighted average, which again would favor technology, is breaking below the 50-week moving average for the first time since it got above it over here in early 2023. Again, that you can see that happens at the beginning of 2022. We broke the 50, and we were unable to get going, and so that's this is an index, a ratio that's very strongly correlated with the S&P. So when it starts to falter, the S&P tends to falter. And the other ratio we like to look at is the Qs relative to IWM. It's breaking down the 8-week moving average. If you take a look at the daily chart on this here, give me 1 second. Remember, it had been holding up because IWM is just as bad, but it's finally broken in the last couple of days below the 17 and the 30 week, now flirting with the 50-day, moving averages, and the ratio is starting to turn back up. It's slightly negative now, but starting to turn back up, and we've clearly got some divergences here, like on the MACD with these higher highs and the lower highs, and so there's a good chance that we continue to move lower on this. And if that ratio turns back to being positive, again, it's going to be hard for the markets to be bullish if its biggest components don't have the relative strength to lead that charge. XL, whether it's XLK or whether it's XLY, which is also obviously been strongly bearish as well, and very, very bearish from a relative strength standpoint, or for that matter, XLC, which has been holding up better, but you can see is flirting with old lows. Breaking down from its ratio, the highs in this ratio, and losing relative strength there. So it's been holding up much better, but it's losing, or it's starting to lose some of that relative strength, and potentially joining the other two in the wrong category there. Takes us to our trade of the day, which again is another one of those stocks that's in kind of both XLK and XLY. It's Airbnb. Airbnb, you can see, has been breaking down here. Let's go to its market forecast chart first. You can see it's just turned dark pink shading in a red line. The intermediate line is broken below. Its market sentiment is moving into the lower reversal zone. If you take a look at the weekly chart for Airbnb, we are back below the 40-week exponential moving average. Lower close, closing below yesterday's low. Close to another death cross situation there. If I take a look at the 3 red arrow chart, 3 green arrow, but it's obviously 3 reds right now. We're breaking the 200-day. We're breaking below old lows. We're breaking out below the point of control, potentially out of the value area. You can see the momentum and stochastics showing bearish signs. Looking at a lot of these other oscillators, they're also showing bearish signs, above 30 on the negative indicator, almost below 20 on the positive. The ADX just starting to turn higher, as bearish as we've been, and we still don't have a trend there yet. RSI is below 40. The CCI is well below minus 100. Looking at the Ichimoku cloud, you can see we're below the cloud, well below the cloud. The rate of change is negative. We have an intermediate strength trend developing on the stock. Looking at the Bollinger Bands and the Keltner channels, we are not close to the lower band. The band width is pretty high, that's why, but we are breaking below the lower Keltner channels, some pretty decent momentum to the downside. So, of course, that led me to doing a bearish trade. We looked at doing a long put vertical spread, selling the low 20 delta, so selling the 115, buying the 120. Position sizing like we always do for around $500 of risk, getting about a 3-to-1 with some flexibility here. And again, adding to our beta weighted deltas here, negative beta weighted deltas, which means, again, if we're going to get a big bounce here pretty soon, probably going to want to hedge those negative deltas to the upside. With, in this case, I'm using the micro ES contracts to beta weight that, but that might be something that you might consider because, again, the rally won't last very long. It will be quick, it will be fast, and then we'll rebound. And whether or not that rally takes us out of some potential max gain opportunities on these bearish trades, at least that a hedge would help us to be able to at least profit during those few days. While we have plenty of negative deltas to the downside if we keep going down. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.